Hey there, everyone. My name is Ryan Schul. Welcome to my data science channel. I talk all about different topics relative to data science, machine learning, AI, and things like that. A lot of my videos focus specifically on finance. I got my MBA in finance from Johns Hopkins a number of years ago, about 2 decades ago, a little bit more. So I tend to focus a lot on finance, and this is the topic we're going to look at today. I want to look at alpha signal discovery using alternative data, and we're going to use Python, of course, right? So what is alpha? Basically, it's the excess return of an investment or trading strategy relative to some kind of benchmark. Usually we look at the S&P 500, because if you just say, I made 2% last year, is that good or bad? It really depends on what the S&P 500 is doing. If you made 2% and the S&P is negative 20%, that's excellent. If you made 2% and the S&P is positive 15%, then that strategy kind of sucks, right? You're not really doing a whole lot of good for your investors, right? So we want to look for positive alpha and measure this relative to some type of benchmark. So what is the purpose and what are we going to do here? Trying to forecast short-term interest rates and detect trends, whether interest rate movement is going to have an impact on alpha or some type of investment strategy that we can profit from. We're going to understand behavioral sentiment. Okay, so consumer sentiment, or I'm sorry, investor sentiment is how they feel about the market. Is it positive? Is it neutral? Is it negative? We're going to enhance trading models, look at a couple trading models. This topic of alpha is actually very interesting. So I might actually create a couple more videos based specifically on alpha trading signals. We're going to look at causal hypotheses and try to validate alternative data, right? And see if this is a good opportunity that we can use to trade on. So the first thing I'm going to do here is pull in some data from this endpoint right here. This is called Pytrends. This is a cool little thing that I just discovered recently. So you can put in different keywords that you're looking for, and it's going to tell you how frequently that word was searched for. So here's a good example over here. Here's inflation, recession, and interest rates. Okay, each relative color corresponds to the number of searches. And you can see this is Google Trends right here. So inflation, interest rates, and the change over time, right? And then where these searches were made, presumably. I'm just starting to get into this this data right here, and I think the darker states probably have, what's it say right there? 40% inflation, recession. Okay, so this is, I guess, the origin of the search. That's what I'm guessing. I'll say it specifically here. Subregion, metro city. Oh, this is actually interesting. Okay, I want to go off on a huge tangent here, but this is pretty cool, this Google Trends thing. So this is something new for me. I just discovered that. If we just go to googletrends.com, you can look for anything you want. Okay, so if you look at what is today? Kentucky Derby. Is that on it? I think so. K-A-N-T-U. Oh, it wants a capital K. Okay, that's fine. Doesn't really matter. Okay, so today's actually May 3rd. You can see there's a big spike up on May 3rd, 2025 about Kentucky Derby. So this Google Trends thing is pretty cool. That's essentially what this Pytrends is doing. So we're pulling in these trends. It comes in as a list. I take the list and I pivot it just so it's horizontal. Okay, so this is the data coming in. This is the pivot right here. Columns is going to be keywords and value is going to be trend score. Okay, so we start with 159 rows and 3 columns. And then we end up with 53 rows and 3 columns. Okay, so that looks fine. Now let's go ahead and pull in the S&P 500 data. This is going to be our benchmark. Okay, so I'm pulling in by the close price, setting the index name to date. And then if you look real closely, this comes in week-end data. So this is 4/28/2024, 5/5/2024, 5/12/2024. So we have to match this by doing a special forward fill. So our dates in the S&P 500 match what we're getting from this Google Trends. I'm sorry, from the Yahoo Trends. So, or Pytrends, it's called Pytrends. So 4/28, 5/5, 5/12, 5/19, 5/26, and that's exactly what we see over here, because we're going to merge these 2 data frames together, but we have to merge in the dates, and if the dates are all scattered all over the place, we can't do the merge. Okay, so we have to sort of manufacture or refactor the dates from the S&P 500 to match what we're getting from Pytrends over here. Okay, so that is just something to keep an eye out for. And this is how we do it. We forward fill the S&P 500, right? We take a look at both of them match, and we can do the join right here. We're going to do an inner join to get those merged together. So we have inflation, interest rate, recession, S&P 500, and then next return. So I'm actually going back one day. I'm going backwards one day just to look at the return, what was for the previous day. Okay, so hopefully that makes sense. So we've got everything aligned pretty well right now. I want to look at the correlations between these search terminologies, right? Inflation, recession, interest rates, and see if that has any kind of correlation with the S&P 500 next day return. That's where we're getting the next day return. And we can see over here, there's a slight correlation, 10% for inflation, negative about 17 for recession, and positive about 1 for interest rates. So no significant correlations there, and that's fine. We just do the analysis just to see what things look like, right? Okay. So the next thing I want to look at is rolling correlations over time. So we know that there's no specific point in time or like 1 day correlation between these terminologies, right, and the S&P 500. But what if there was some type of correlation on a moving average or on a moving basis that we could discover and use as a positive alpha signal, right, to generate above average returns? So that's what we're looking at here. So we have a rolling window of 30 days. So it's a 30-day lag. We're going back 30 days and taking all of the inflation, recession, interest rate correlations, right, and then plotting the results right underneath. So you can see the change in time. So between inflation and the S&P 500 return, there is kind of a decent correlation here. We usually look for, we always look for 0.7 or higher. This is definitely higher than what we saw before, because in the point in time analysis, there's really no correlation here at all. 11% is really nothing. This is negative 17. That's slight, but pretty small. This is 1. That's absolutely nothing. No correlation. Over here, we see a more substantial correlation, 50%, but still low. Remember, we need 70%. This is almost nothing, and this is basically 0, right? So recession is 0. And we saw, if you look at the point in time, we saw a slightly negative correlation. Now over here, it's pretty much just 0 all over the place. Although it does kind of crash down a little bit over here. That's interesting, right? But again, no significant correlations that we can use for a trading signal. So let me look at another case here. ANOVA is a type of analysis we can do. It's called analysis of variance. And we look for a high F score and a low P score. So anything that has a P score of 0.05 or less is going to indicate a larger relationship between the search terms that we're looking at, right, and the S&P 500 returns. But it's 0.59, right? That's way too high to have any kind of statistical significance, right? We need 0.05 or less. So again, we tried the analysis, but it just simply didn't work. Let's try to bin the data. Now we're going to take everything, because this is coming in weekly, right? We're going to take this weekly data and combine this into, I think there's 4 different bins. I think that's what I picked over here. So we're looking at the average of bins. So mean is average in the statistics world. We are looking for a score bin and taking the next return average and creating 5 different bins for that. So we have 0.036. For the first bin, it's really 0 through 4, but Python is 0 based. So you just start with 0. You don't start with 1. So we have 0.036, 35, 18, and 0.092, and then the negative 0.008, right? So pretty low numbers here. I mean, we're not even at 1%. Next day return. So that, again, is another type of analysis. We tried a few ideas, but nothing has worked so far. Let's look at this right here. This is based on the low bin and the high bin. So the high bin would be 0.092. The low would be 0.0018. So I'm looking again, is there any kind of statistical significance between these bins and our ability to predict the S&P 500 return for the next day, there still isn't, right? We need 0.05 or lower. We're getting 0.38. So there's really nothing that we can do here, right? But we can try, we can make another attempt. We can do linear regression. I'm going to say the independent variable is recession and the dependent variable is next return. And you can see over here in the, actually, let me just print it out because I think I did make some modifications to the data frame, merge data frame. Let me just take a quick look at this thing and see what it looks like right now. Quantified, DISPLAY. Okay, yeah, so we're looking at, is there a relationship between recession and next return? So recession is in the data frame here, and the next return is showing up in the data frame there. That's good. I'm going to cut this out. I don't need that at this point. So you can look at my other videos about machine learning. Any kind of independent variable is an X, is assigned to the X feature right here, and this is what we're trying to predict. This is a Y variable. It's also known as a target variable. So I want to see if there's any significant predictive capabilities using this regression model. Can I predict, based on recession, the next return of the S&P 500, and their predicted returns right here are all pretty low. So it's really no useful value between this, right? So this is kind of not generating any alpha signals that we can use to do our trading on, right? But now we're working with a macro sentiment proxy. So like I showed you before, the Google Trends is very cool. You can look up any kind of search term, right? And it shows you the frequency of that search terminology, right? So we're going to try to use this again to do forward-looking returns. So next day return, and we're going to set up another example here. We're looking at the cumulative product over time. So this is the sum over time of the next return and the strategy return that we set up over here, looking at the signal and the next return. Okay, so the signal is going to be coming from here. These are the predicted returns. Is a predicted return greater than 0? If it is, give me a 1. That's going to be positive. So I want that signal. I want to see if that's greater than. That's going to be a buy signal. If it's not greater than, then it gets a -1. Okay, so this would be a buy right here. We're going to buy into the S&P 500, assuming that it's going to have a positive return tomorrow. Otherwise, it's going to be a sell signal. Okay, so that's how we get our signals. That's how we get the strategy return. And we're looking at the cumulative market over time. So this is the cumulative product, right? And the cumulative strategy, again, this is the return. So we're looking at cumulative market returns, and here cumulative strategy returns. Okay, so let me refresh this. So we have our cumulative market. Here's the signal, right? These are buy signals. So this is a 1. Strategy return is positive. Here's cumulative market and cumulative strategy. So let's plot this result right here, and see what we get. So I'm looking at cumulative market and cumulative strategy, okay? And we can see the market is in red and the strategy is in red and the market is in blue. So this cumulative strategy, cumulative market scenario actually is outperforming the market, and it's pretty significant over here, right? So we are getting cumulative returns. Looks like we're going back in time about 30 days. I think that's what this is. And remember, we grabbed 1 year's worth of data, right? So this is the S&P 500 data. We have 1 year's worth of data here. We're going back 12 months, right? That was for the Pytrends. We go back one year, and for the S&P 500, we're going back in time the same period, 12 months, right? And again, remember, we have to match up on the weekly data and the weekly data. So once you do that, everything falls into place. So we did a lot of legwork there. We finally found a strategy that pays off, and this is based on the cumulative market and strategy over time. If you want, you can print out all of these buy signals, right, and see what is going to transpire week to week. So again, this is weekly data: 5/5, 5/12, 5/19, 6/2, right? So end of the week data, and the strategy pays off. So the strategy outperforms the market. The red line is the strat, right? The blue line is the market. That's the S&P 500. So finally, we did a lot of work, but we found something that pays off. It's pretty significant. So the deviation between these two is pretty substantial, actually. So good job there. We did it. We found a strategy that works. Did a lot of work to get there, but we finally found something that works. And that's how these things go, right? It's iterative. You try a whole bunch of ideas, find something that works, and then you deploy that, right? So there's less drawdown for the strat. You can see that. It's pretty obvious. And this is a positive alpha signal. Since the strategy is driven by the Google trends that we saw before, right? Inflation, interest rates, and recession. If you see a lot of these counts coming up, this is a good indication that we can utilize this strategy looking at cumulative market returns and cumulative strategy and generate a profit from that. Okay, so one last thing I will show you here is the Sharpe ratio and hit rate. So the Sharpe ratio is the risk-adjusted return. You want a positive Sharpe. The higher the better. I've seen these go up to about 10. That's pretty phenomenal. Usually that is very short term. It doesn't last too long. 1.7 is okay. It's not fantastic. It's not horrible. It's a decent. Sharpe and hit rate of 60%, just over 60 is decent. Anything greater than 50% is considered high. So we have a high hit rate and we have a positive Sharpe ratio. Again, positive is good. Negative is bad. You could have negative Sharpe rate if your returns after adjusted for risk divided by the standard deviation or the volatility of the portfolio. If that's negative, then you're losing money. But again, it's all relative to the market. If you have a very slight negative Sharpe and the S&P 500 has a huge negative Sharpe, you're still winning, right? If you have a Sharpe of 1.7 and the S&P Sharpe is like 2 or 2.5, I don't think it would get to that, but if it was 2.5, maybe there's a few big bullish days in the market or something like that, then even though your Sharpe ratio is positive 1.7, if somehow the S&P got to 2, again, I don't think that would happen, but if it gets to 2, then the S&P is outperforming you, so your strategy is not working, right? So just to wrap it up, some practical use cases here are macro trading desks, equity strategy, hedge funds, quants, of course, long short, risk managers, right, to understand the riskiness of the market for their investors and whoever you report to, right? Even if you're a CEO or a top lieutenant at one of these investment firms, you still have to report to your clients, right? So that's really your boss. Your client is your boss at that point. So this analysis bridges fundamental behavior, some technical behavior, behavioral finance. We can turn public raw data into measurable indicators and generate profits from this, test whether signals are statistically valid, and potentially enhance alpha generation trading systems. So the last thing I'll say here is this is just a strategy. We proved that it works. But I mean, don't come after me. Don't try to sue me. I actually don't even have any money. I've been unemployed for about 18 months. Okay, I lost my job about 18 months ago, so I don't have any money. This is just a technique that shows you how the math works, how the statistics works, how the functionality works. That's all it is. But if you invest in this based on the analysis we did, we should make money. If you lose money, don't get mad at me and don't try to sue me because I don't have any money. Okay, I'm just demonstrating the functionality of the concept and the technique and showing you how to execute. So I'm going to share all this code with you guys like I do with all of these videos so you can copy and paste it and run it in your own Jupyter environment. Or you can, I always save these as HTML files. I like HTML. It's pretty easy to work with. If you want to convert that directly into a Python notebook, PYNB, I forgot what the extension is. Python notebook, you can do that. It's just a couple lines of code. I actually forgot how that works, but I've done that a few times. You can Google that. So I'll save the HTML file, share it with you. If you want to convert that into a Python notebook, you can do that with a couple of lines of code. I'll leave it to you to figure out how to do that. Thanks for your time, everybody, and I'll see you in the next one. Goodbye.